They didn't announce it on CNBC. They didn't warn retail traders. They waited until most people were asleep. Overnight, the rules of the silver market changed. Not supply, not demand. The rules. If you woke up and saw silver suddenly dip, felt that familiar fear, and thought, "Here we go again," stop right there. Because what happened last night was not a crash. It was a pressure test. And for the first time in decades, it failed. Today, I'll show you what a margin nuke really is. Why it worked in the past, why it didn't work this time, and why this moment may have changed the silver market forever. Late at night, while New York was dark and Europe was waking up, the exchange quietly raised margin requirements on silver futures by roughly 50%. That is not a routine adjustment. That is a shock move designed to force selling. They didn't dump metal onto the market. They didn't fix supply issues. They simply made it far more expensive to hold silver positions overnight. This tactic has a name on Wall Street. It's called a margin nuke. Most people think silver prices are set by people buying coins or bars. That's not how global pricing works. Silver's price is set in the futures market, where massive leveraged contracts control price discovery. Until yesterday, controlling 5,000 ounces of silver required roughly $12,000. That's about 25 to 1 leverage. Leverage is what makes prices move fast. But leverage is also the kill switch, and the exchange controls it. Here's what happens when margins suddenly rise. Imagine a hedge fund holding 1,000 silver contracts. Yesterday, they needed $12 million in margin. Overnight, they're told they now need $18 million. They have hours, sometimes minutes, to wire $6 million. At 2 in the morning, that money doesn't magically appear. So computers step in, positions are sold automatically. Not because fundamentals changed. Not because demand disappeared, but because the house changed the buy-in. This playbook is old. In 2011, the exchange raised silver margins 5 times in 9 days. Silver collapsed nearly 30%. In 1980, margin hikes helped cut silver prices in half. Back then, silver was a speculative trade. Vaults were full. Supply was available. When paper traders were forced out, there was no real buyer underneath the market. The buyers of silver in 2025 are not the buyers of 2011. Automakers don't buy silver on margin. Tech manufacturers don't buy silver on margin. Governments don't buy silver on margin. They pay cash. So when leveraged paper traders were forced to sell, physical buyers stepped in. That's why silver dipped briefly and then stabilized. This wasn't a crash, it was a transfer. We are no longer in a paper-driven rally. We are in a physical shortage. Vault inventories are tight. Refineries are stretched. Delivery times are growing longer. You cannot margin hike geology. You cannot paper bomb a supply deficit. The margin nuke is a paper weapon. This is a physical market. This didn't happen by accident on a Friday. Weekends scare banks. Futures markets close. Paper control pauses. Asia wakes up. So they pushed prices down before the weekend. But instead of killing the rally, they created a bear trap. Weak hands sold. Strong hands accumulated. The price floor is now stronger than before. If margin nukes no longer work, the options are limited. Forced position limits. Or liquidation-only trading. Either move would damage confidence in paper markets. That's the trap. And the market just proved it. Nothing about today changed physical reality. An ounce is still an ounce. Scarcity is increasing. Demand is rising. Paper control is weakening. The margin nuke was supposed to end the rally. Instead, it showed who really controls the silver market now. Ignore the noise. Stay patient. And understand what you're actually watching unfold.